Do you consider the historical HV against the implied volatility when you enter a trade, like the VRP in the SPY? So short answer, yes. VRP, for anybody who doesn't know, is essentially implied volatility minus realized volatility. So the VIX index is a 30-day forward implied volatility minus the 20-day historical volatility. This is what's called the volatility risk premium. And the theory goes that because forward looking is more uncertain, of course, traders are going to need to get paid a little bit of a premium to be taking on future trades. So the implied volatility in a calm market should probably be higher than the historical realized volatility. So that would be a good signal to take trades, right? But what I do is I go a little bit further. I design my own VRP, which I call the trader's VRP. I actually show people exactly how to calculate it. If you want it, it's there. It's there, and then it's here as well. You can actually calculate it yourself, but what it essentially is a slight variation. So it's a 5-day weighted moving average of the VX30, not the VIX. The VX30 is the constant rolling 30-day maturity of the front 2 months of the VIX futures. So I like to use that because it's far more specific to volatility products. And then we're going to subtract a rolling 5-day HV. And the trader's VRP is really good because it's basically a signal for risk on, risk off. If the trader's VRP dips below zero, that's definitely a warning sign that the market is showing signs of weakness. So you might want to exit to cash or use it in combination with multiple other metrics. But you can see I did a super simple test, just proof of concept basically here, where just using that one single metric, if it's above zero, you're long the SPY, and if it's below zero, you're in cash. So 87% of the time you'd be in the trade, S&P 500, and 13% of the time you'd be in cash. Buy and hold is here. Using that simple one metric filter, you can actually improve the performance substantially. I mean, it might not seem like much, but the difference between 8.3 and 9.5, it's about 15% difference. That's significant. And also the drawdown goes from 55 for buy and hold down to 37 for using that one single filter. The point is that yes, this is actually a very good signal. And when the VRP dips negative, it is a sign that there's something maybe fundamentally wrong or at the very least dangerous with the current market.